Welcome to Build Your Wealth Muscle, a podcast dedicated to helping fitness entrepreneurs build wealth by saving taxes and growing their money. Each episode will break down different strategies in the areas of business, tax, and retirement planning specifically for your coaching business. Disclaimer, the topics covered in this podcast are for educational purposes only. This is not advice for your specific situation. Please consult a qualified financial or tax professional before making any changes to your financial or tax situation. Now here's your host, certified financial planner and tax advisor, Pat Darby. On this episode, you're going to learn your last chance retirement moves for 2025. We're going to dive into how to maximize your HSA, your health savings account. We're going to find out, is your financial advisor potentially wrong about your Roth IRA eligibility? And then finally, at the end, we'll go into, is there still time for you to do a solo 401k for 2025? As always, if this episode helps you or brings you value, please do us a favor and share it with a friend. Thank you and enjoy the show. Hey everybody, welcome back to Build Your Wealth Muscle. Today, we're going to dive into a little bit of planning in terms of 2025. So as I'm recording this, is March 1st of 2026. But most of the tax planning you're going to hear about on social media and podcasting is going to be focused on 2026. And that's fair because the majority of strategies are in the current year, not a lot in the prior year. Today, we're going to focus on what are the few that are prior year. So 2025, because again, I'm recording this in 2026. So I call this like tax overtime. It's a term I think I made up. I don't know. Maybe other people use it and I heard it from them. But it's sort of referring to the investment side of things and retirement planning, because a bunch of things have the ability, you can still put in 2025 contributions and the April 15th is the deadline. So let's go through that's going to be related to the HSA. We're going to talk about the IRAs, and then we're going to end with some information on solo 401ks. So let's start with the one that is probably the most boring, even though I think the HSA or the health savings account is, I think, one of the best ones because it's one of the only strategies that is triple tax free, meaning that usually when you have a retirement vehicle, on the way in or on the way out, you're getting hit with tax. So like with the IRAs, on the way in, you get this tax savings. On the way out, you pay tax at your income bracket. Roth, it's flipped. You get no deduction on the way in, so you pay tax on the way in, and on the way out, you get no tax. So if you've done well investing wise, it's a big winner for you. HSA is the only one where you put the money in, you get a tax deduction. When you pull the money out, you get no tax if you use it on a qualified medical expense. All of those in the middle are the same in that they grow tax free. So if you have capital gains, you're trading, you're receiving dividends and interest, no tax. Again, it's only on the entry or the exit where usually there's tax. Health savings account doesn't have that. So I'm a big fan of it, especially because depending on who you're using for your HSA provider, you can keep track of your HSA eligible expenses, but pay them out of pocket. So for example, you go to the doctor, they say the bill is $150, whatever the case, you pay with your personal credit card, and then inside of your HSA account, you mark that expense as having existed and upload the receipt, do all the documentation things, but you don't have to actually withdraw the money. Obviously, if you need the cash because you couldn't afford to pay the credit card, that's different. But if, let's say, you're in a position where you just want the record of it, but you can pay it personally and you can do that for years or decades, once you're ready, you can take a tax-free distribution. But meanwhile, you're using the time value of money on your side, saying, all right, I'm going to leave the money in the stock market or wherever you have your HSA. And it's going to build more wealth for me. And then in retirement, I'll pull out the tax-free, and then the rest will just be there to pay your Medicare premiums as an example. But now you still have until April 15th to make your contribution. So let's dive into some of those numbers. So again, sorry for anybody, well, even the video listeners, these numbers are not in front of you. So for 2025, you could put two contribution, either as a single individual of $4,300 or as a family $8,550. So again, if you haven't made your 2025 contributions yet, you still have time to do it. Now, here's the caveat. Let's say you didn't have an HSA plan all year. If you had an HSA plan as of December 1st of 2025 and you hold it all of 2026, you are eligible to put in the full amount of 2025. So if that's you and you're saying, well, I got my plan towards the end of the year, make sure you hold it all of 2026. You can make your 2025 contribution. Then, of course, you're obviously eligible in 2026 as well. If you do pull the money, if you do lose your HSA plan, then you're going to have to withdraw some of those contributions that were not allowed for 2025. And those will obviously be taxable. And then you're going to also pay a 10% penalty. So don't do that unless you're very confident you're going to hold it all of 2026 as well. But if you're a big fan of the HSAs, you probably will anyway. For 2026, you can also send, again, I'll get into 2026 briefly, but if you already made your 2025 or you wanted to do 2025 and 2026 all at once, the numbers for 2026 are $4,400 for single and $8,750 for families. Now, if you're over age 55 for 2025 and 2026, you get an extra $1,000 you can put in unless you're already enrolled in Medicare. If you're already enrolled in Medicare, talk to with somebody because you're probably ineligible to use the HSA completely. Anyway, so again, that's the HSA. There's no filing extension. April 15th is the deadline, whether you do an extension or not. All right, now let's get into the IRA. So there's going to be the traditional IRA and the Roth IRA. This is going to be a little bit dense in terms of numbers. So I'm going to try to do my best to explain it and then don't necessarily focus on the numbers, just focus on getting more information on your situation later if it sounds like this is you. So now, if you're not participating in a retirement plan, what's nice about IRAs, so let me take a step back. Traditional IRAs and Roth IRAs, they require earned income. So you have to have a job. And this is even that's why we talk about like with paying your kids. It's the same thing with them as well. So if they are 10 years old and they have a paper route or they do babysitting, they have earned income. This could be applicable to them. And if you're a married couple, if one of the spouses works, both spouses get eligibility. So that being said, again, like you can't be somebody who just has investment income. And so again, it has to be earned income to be able to do this. But now there's different phase outs that you have to worry about, because if you have a retirement plan at work, you may be phased out from being able to take the tax deduction. So let's go into that. So if you're single in a retirement plan and you make more than $89,000 last year, single, or 146 married, you can't use the deduction for an IRA. So now you can still use, this gets potentially confusing and I don't want to go deep into this, but I just want people to, the main theme of today is that you could probably put more money into 2025, but I just want to give you a heads up on that, especially that my business owners listening to this. I'm going to give you your strategy in a few minutes because you shouldn't be worried about these numbers because there's a different way to go about it. And again, because as a business owner, you don't know where you're not a W-2 employee. You don't know where your income's going to fall at the end of the year. Obviously, you hope you exceed all these phase outs because that means your business is doing well. So again, single, you have to worry about it if you're making between 79 and 89. Married, 126 and 146 for 2025. So if you are doing more than that, you can put the money in, but you have to get no tax deduction for it. Before then, you take the tax deduction. So for 2025, you can put $7,000 in. For 2026, now you can put $7,500 in. So again, I'm mostly focusing on the people who are in 2025. You know what your income was, whether or not you make a contribution, it's going to be deductible under 89 or under 146. If you're over age 50, you can put another $1,000 in. That's the catch up is 50 instead of 55 when you're comparing it to the HSA. Now, I think the Roth IRA is like, quote unquote, the gold standard of retirement plans because, especially depending on what you're interested in investment wise, if you are savvy in alternative investments, like if you want to bet on crypto or you're very good with picking stocks, even if you want to buy private equity, what's nice about the Roth is you can put that money in, especially if you're a business owner right now listening to this thing. I'm at the early stage of my business. I'm really not making that much money in terms of my income bracket. So you might be interested in just sucking it up and paying the tax at that lower level. Now it's in a Roth. you never have to pay tax again. So now when you are in retirement and your business is doing multi seven figures, and now you're in maxing out all the brackets, you don't worry about it. The future tax brackets don't bother you. It's kind of like the devil you know, because no one loves paying taxes, obviously, but the devil you know of current tax brackets may be more palatable than having no clue. Like you look historically back over the last 40, 50, 60 years, the top brackets have been all over the place. I think in the 1960s, they were 91%. As early as 1981, it was 70%. Now it's the top one is 37. So again, it can be relative, like how painful it could be. When you do the Roth, you don't have to really worry about it. You've already paid the tax in your younger years, and now you don't have to stress that bucket of money. Because it's so great, there are restrictions. And the IRS basically says, or Congress basically says, you can't put money in if you make too much. So they'll say, if you make in 2025, if you made more than 165 as a single person, you can't put money into a Roth IRA. Or as a married person, if you guys made more than 246 in 2025, you couldn't do it. So 165 and 246, they say you can't do it. Now, again, we're going to talk in a minute how you can using a loophole, but that's what they'll say. And so the contributions based on that is $7,000 for 2025, $7,500 for 2026. The Roth IRA and the traditional IRA, just a step back, I guess, to combine the two, those limits are always the same every year. And you don't get both. So you get a total of $7,000 for last year. So for whatever reason, you're like, hey, I'm going to put money into my IRA and my Roth. You get $7,000 total, not each. So if you're like, hey, I'm going to put $5,000 into my Roth, you can only put $2,000 into your IRA. So it combines for $7,000. Again, I don't know too many people doing that, but that's the rule. Okay, now let's get into the backdoor Roth, because that's where most people listening are going to fall into for two reasons. One, as a business owner, again, we just went through all the income issues that you have to deal with. As a business owner, you've got enough on your plate. You don't know when you start the year where you're going to be. Even if it's your first year in business, your goal is probably to have more than $100,000 of net income at the end of the year. So you're going to phase out, well, maybe not if you don't have another retirement plan, but you may start to phase out of the Roth one. And you definitely could phase out if you have any sort of retirement plan. Say maybe you have your business, but then you have your 9 to 5 because you didn't give up the business completely. You didn't give up your day job completely. So for my business owner people, I always want to use, if I can, again, I shouldn't use the word always, but for almost everybody, I want to use the backdoor method, because then we never have to worry about all the procedures to undo a Roth IRA that you weren't allowed to do in the first place. So we always try to use the backdoor Roth IRA. And so there's a couple things you have to know. One, it's a no-brainer. Obviously, like let's say you phased out of the IRA deduction, then it's another reason to do it. But again, I'd like it mostly for my business owners because we don't know where you're going to end up and we don't want to have to track that all year. We want to just be able to make those contributions for you. And then if you have a year that you expected, great. If you far exceed it, then amazing. We don't have to do anything. But here's where it gets tricky as a business owner, because there's a rule with this backdoor Roth IRA called the pro rata rule. And you can't do that. Well, it adds taxation, but essentially you can't do the backdoor if you're holding other IRAs. So if you have a SEP IRA hanging out there, if you have a traditional IRA out there, if you have them from other places, maybe you had a 401k at work, you rolled it over to a regular IRA. Now you reach out to your financial advisor, you're a business owner now. You're like, hey, I want to do the Roth, the backdoor Roth. That is going to become a problem because anything that you move from into your Roth that way, they're going to run a calculation as a percentage of what your other accounts are. Now, that's easily fixable because you're a business owner. You could potentially, again, it's going to depend on whether you have employees or not, but the dollars that you have in 401ks are, for this pro rata rule, are treated differently than dollars you have in SEP IRAs and traditional IRAs and rollover IRAs, things like that. So what a financial advisor, tax strategist is going to tell you to do is, okay, now you're a business owner. If you have SEP IRA money, if you have rollover IRA money, let's create a solo 401k and roll it all into there. Now, when we run that pro rata test again, the dollar value is 0 and we do the backdoor. So let me explain the backdoor, because again, it's pretty simple in concept, but it's the pro rata rule that people can jack it up if they try to do it on their own and forget that one little piece. But essentially, you're moving all of the $7,000 in this hypothetical. You're doing $7,000. You want to max out your Roth IRA. The way you do that is you roll it first into a traditional IRA that you will not take the tax deduction. So we'll call it a non-deductible IRA. But at a regular custodian like Schwab that we use, it's just a regular IRA. There's no like such thing as a non-deductible. It's just how you treat it on the tax return. So then as soon as that 7,000 hits, you're going to then roll it. Essentially, it's a Roth conversion, almost like, except there was no taxation deducted. There's no taxation added when you now put that 7,000 into the Roth. And so that's the procedure you're going to do every single year. So the goal would be to keep all your pre-tax money inside of 401ks, and that way you can do the backdoor every single year. Again, there's going to be issues with that if your situation precludes you from being able to move things into a 1K, which may be the case if you have employees and you're like, well, I don't want to have a 401k right now because then I would need to include them, and maybe you can't afford to offer benefits at the moment. Totally understandable. But you're going to have to talk to your financial advisor about that, or your tax advisor, whoever is having these conversations with you. Now, that kind of leads us into the last portion of this. So let me just back up real quick. Just to make it crystal clear, for business owners, I recommend the backdoor Roth, because even if you wanted to do a regular Roth and you're barely making any money, you just eliminate the complexity of having the conversation at the end of the year that, hey, you made $10,000 more than you were allowed to. And again, instead of celebrating that you had a better year than expected, now you're dealing with a headache, trying to unwind and figuring out if there's going to be any excise over or contribution penalties they have to deal with, and unwinding it before your tax return and things like that. Talk to somebody about doing a backdoor Roth. But more importantly, if you're dealing with a financial advisor who just looks at your income and says, oh, you made too much, you can't do a Roth IRA, call me, because that person's giving you incorrect information. All right, so now let's get into the solo 401k. This one's the most limiting in terms of going backwards. So for 2025, there's essentially three buckets that you have to worry about. There is the the employee contribution side. Then there is the employer profit share business side contribution. Then there's like a third after-tax bucket that we're not going to get into today. But essentially there's the three, but the two big ones are the employee side and the employer side. If you had the plan established in 2025, then you can make sure you can put into your 2025 contribution of 23,500. The total amount is 70,000, and you can still put in those contributions if the plan was established. But it gets complicated for S-Corp owners because what you put in has to be on the W2. So if you didn't already put what you were going to do in January on your W2 that went out on the 31st with your payroll provider, then you are stuck. But you still have the ability to put in the employer contribution side, which is 25% of your wages, and you can do that up until your filing deadline with extensions. So the total number for 2025 is 23,500 on the employee side, and then the total is 70,000. For 2024, if you're listening to say, oh, damn, I missed some opportunities, 2026, you can put up to 72,000 total in, with 24,500 being the employee contribution side. So again, for the W2 people on S corporations, 12/31 was really the deadline. You can't exceed your W2 wages. That's another important key factor here. So if you're paying yourself 20 grand, then you can't put in the 23,500. And then the employer side is capped at 25% of those wages. So again, if you're paying yourself 40 grand in that hypothetical, the max contribution on the profit share employer side is only 10,000. And then again, this is the only one, the solo 401k that I talked about today, that you can file an extension and get 6 more months, because the deadline for your S-Corp is March 15th. You can file an extension and push this solo 401k contribution to September 15th. Again, the Roth IRA, the traditional IRA, the HSA, they do not have extension deadlines. Now, the only one we didn't really talk about today is the SEP IRA. And that's because that one you can do up until October. But I don't really like the SEP IRA very much. I feel like you're only doing it as like almost a repair, like nothing was put in place. So you had to do something at the end of the year. But again, I don't love it because of what we just talked about before. It could jack you up from trying to do some backdoor Roths if you can't move that money right into a solo 401k. So hopefully that's helpful. Again, I know I threw a lot of numbers at you. The main thing to really take away from this is that you still have opportunities until April 15th to make your 2025 investment retirement account contributions. Talk to your financial advisor or your tax advisor on what you're eligible for. You want to look at your very specific situation. Again, don't do this. If you know the numbers, obviously do whatever you want on your own. But if you don't know the numbers and you don't know some of these little rules, don't start doing this DIY in your like Schwab account or something like that, because you can easily miss what your eligibility is. But anyway, hope this is helpful, and I'll see you on the next episode. Have a great week. Thank you for joining us this week on Build Your Wealth Muscle. The links mentioned in this episode are available in the show notes. For video clips and more information on tax and retirement strategies for fitness entrepreneurs, please follow my Instagram @ThePatDarby. If you found value in this episode, please do us a favor and share with a friend. If you tag me, that'd be appreciated also. Lastly, for help implementing any of the topics discussed, please book a call. The link is also in the show notes. Thank you again for listening, and have a great day.